Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Coming to you from Palm Springs and the greater Coachella Valley area. And as you know, when we start this program, you know what? Can you believe it? It's the end of February already. Tomorrow is, anyway. We're going into March. I like March, especially the first half. We're getting into spring baseball. Baseball's coming back here, not too much longer before the season is live. And then, of course, we've got the March Madness tournament coming up. And as well, here locally, we have the PNB Paribas tennis tournament. So a lot of good things happening here in the Coachella Valley as well as in the country as a whole. We're going to go ahead and start with our usual routine of giving you an update on mortgage rates and the bond market. And we've got some pretty good news. Mortgage rates are not only stable, but trending a little bit downward. Here's our rate grid. We try to keep this up daily. Again, you can read the tab at the bottom about mortgage rates to get a better idea of how mortgage rates are determined from day to day. We've got a short video there that where I go into some detail about that. But when you look at these rates, it's some pretty good news. Conforming 30-year fixed, we're down to 6.25. Buy downs are not far behind that at 3 3/8, 4 3/8, based on a 3-2-1 or 2-1. And FHA VA now both are under 6 again, so that's really good. And even those jumbo loans are getting into the low 6s. And look at that, a 7-year ARM jumbo loan at 5 7/8. We haven't seen that in quite a while. So that's pretty good news. So what's going on there in terms of why these rates are trending a little bit better? Well, I think in part it's just things are just kind of normalizing. There's our 10-year bond chart, and we like to see that kind of slope, if you will. Last Friday, of course, is where this chart starts, where we're up there pretty high on the yield, approaching about 450. And as of right now, Jeff just updated this just before our program started, down to 426. So that's the kind of slope downward we'd like to see. Actually had a little bit of a dip on Wednesday. And so, as you know, if you've watched the show for a while, Jeff's had a theory that Wednesdays are a good day in the bond market. That sometimes is the case, sometimes not. But if you take this 5-day chart, from beginning to end, Wednesday looks pretty good. I mean, so maybe we'll get to the point where we don't call Wednesday hump day. We'll call it dip day, at least as far as interest rates go. So what's going on in the financial markets, economic data points that is bringing us these kind of yields? Well, in some respects, not a whole lot. I mean, economic data calendar this week was pretty light. One thing I did want to make note to everyone who watches this show, Case-Shiller Index, of course, that is a well-known index that monitors home prices throughout the country. They just released their latest report for December, and their 20-city composite, guess what? In December, values up 4.5%. Again, this is a national number, a national survey, but nonetheless, I think it's pretty indicative of what's going on in most markets. So again, as we keep harping about, rates are up, yes, home prices are up, yes, but they're keeping on going up. They're not, home prices have not really fallen significantly in most markets. So that's why we keep suggesting to folks who are still waiting for lower prices or lower rates, that's probably not been working out too well. And you really ought to reconsider that and see how you can get into real estate and buying a home now if that's part of your short, medium, even long-term plans. Consumer confidence, though, did hit a 8-month low this week. That's mostly about a little bit of uncertainty and nervousness about, is inflation really under control? And the tariffs. The tariffs are getting a lot of news right now. And the Fed's concerned about the tariffs to the extent that they might have a negative impact on inflation. So I think that's what's going on with consumer confidence. It's again at an 8-month low, but maybe these rates trending down will help buck that trend. The big data point for this week is until tomorrow. That's the PCE, the Personal Consumption Expenditures Index. That's the Fed's favorite inflation target. It is projected to be slightly down. So if that proves to be true, if that data point released tomorrow is slightly down from the previous month, that could be good for the bond market. Maybe we'll see a little bit of rally. And who knows, maybe that 10-year bond yield will get below 420 or head toward 415. Of course, if that happens, as I have explained to you many times, that would be indicative of mortgage pricing, mortgage rates improving as well. So for those of you who I've converted into being a 10-year Treasury bond watcher like I've done with Jeff, take a look at that 10-year bond yield in the morning, see where it's at, and look for the news on the PCE. There could be a correlation there. If the PCE is benign or lower than forecast, that should help our bond market and therefore help mortgage rates. And so that's your update on the markets, both interest rates and bond. What I want to talk about today is a little bit about when you're getting a mortgage and you're shopping around for a mortgage, you're getting quotes and so forth. And I'm bringing this up because I just went through an exercise with a new client of ours. I pre-qualified him a couple of weeks ago, and he made some comments about when he was shopping around for rates and how we differed from some of the others. And so I want to get into that a little bit. And so on this slide, what you can see here is, as we put it, wait a minute, you're getting a mortgage. So how much am I paying my broker in fees? And what does MortgageWorks charge in that regard? So I want to cover that topic a little bit. Now, as the slide shows or indicated, we're a broker. So first thing I want to point out in terms of the industry, you can get your mortgage from various different kinds of companies, mortgage brokers like us, what they call a direct lender, which under that umbrella, if you will, that can be a mortgage banking firm. That's not the same as a bank. That's a lender who funds their own loans, but they do it with lines of credit set up with commercial banks. So a mortgage banking company, a large commercial bank, a savings and loan, or a credit union. So believe it or not, in the U.S. Right now, it's estimated about 25% of residential mortgage originations are arranged by mortgage brokers like us. And that's higher than it has been in recent years. And that is, I think, indicative of mortgage brokers can be that we are a low-cost producer. We're very efficient. We're very specialized in terms of the process from initial application with a borrower to delivering a loan package to a lender to be underwritten, approved, and funded. So that's one thing I would want you to know is that, again, mortgage brokers are about 25% of the residential mortgage origination business in the U.S. currently. So then you go on to the next question, which is, well, how are and in this conversation, I'm going to talk about mortgage broker compensation. Obviously, that's what we are, and I think it's important that you understand how we're paid. So how are mortgage brokers generally paid? Well, the primary way we are paid is through a compensation scheme that was actually created and set up by the Consumer Financial Protection Bureau, that agency that right now seems to be a little bit maybe in jeopardy. But going back to 2010, that agency created a whole new scheme, if you will, a regulatory scheme for how mortgage originators and in particular mortgage brokers are paid. And the concept is lender paid compensation. In fact, it's interesting because from time to time when if I'm doing a pre-qual for a borrower and I provide them a worksheet, because remember, I think it's imperative that we give you the numbers right up front, even before you apply for the loan. And so oftentimes when I do that, the person who's really paying attention to the numbers, they'll say, well, all right, this looks good, but where on here does it tell me how much you're getting paid? And I always say to them, well, that's not on the worksheet. And the reason is because we're not paid by the borrower. We're paid by the lender. And the way that works is, when we sign up with an agreement with a wholesale mortgage lender in the industry, the acronym is TPO, third party originations. That's kind of a long way of saying a wholesale mortgage company. That can be a bank, a mortgage bank, savings and loan. Even some credit unions do wholesale, but not too many. But the idea is in the TPO world, what we do is when we sign up with a new TPO lender, a wholesale lender, we have to basically declare what we want them to pay us when we originate and deliver a loan to them for funding. So they'll send us an agreement, and with that will be a chart. And on that chart, it's going to have a grid of percentages. And those percentages generally from lender to lender is going to run from about 1% up to about 2.75%. and that is of the loan amount. So what we're conveying to that TPO lender is, here's how much we want you to pay us each time we deliver a loan to you for underwriting and funding. And so if you think about it, that's a pretty wide range. 1% of the loan amount is quite different than 2.75% of the loan amount. If you're already doing the math in your head, you can kind of realize, wow, are some brokers really, asking their TPO lender to pay them something approaching 2.75% of the loan amount? Well, the answer is yeah, and probably more than you would think. And so that's kind of what I want to get into. So again, the first thing I want you to know is that that's how we're paid. We're going to declare to our lenders that we're set up with what we want to get paid on as a percentage of the loan amount for each loan that we deliver to them. And when we declare that with most lenders, we can also declare a floor in terms of a dollar amount and a maximum in terms of a dollar amount. So the idea would be is, depending on the percentage amount we declare, we then will further declare, X percentage we want with a floor of X amount of dollars and a maximum ceiling of X amount of dollars that would kick in depending on when that percentage, when it's applied to the loan amount, reaches that minimum or maximum. So given what I'm explaining here, I want to show you a question that is, I think, a pretty valid one, and I think it'll help illustrate to you why this is important for you as a borrower to know how much your mortgage broker is getting paid. So imagine this: for a loan amount of $500,000, what is the average lender paid compensation to mortgage brokers in the U.S., and do you think this amount is fair? So Jeff's going to pull up some choices here. Here's A, $7,500 or 1.5% of the loan amount. B is $12,500 or 2.5% of the loan amount. C is $5,000 or 1% of the loan amount. Or D, $10,000 or 2% of the loan amount. Again, we're using a $500,000 loan amount as an example. So for those of you watching, if you look at these choices, just think to yourself, where would you pick the average? In other words, in the industry. And what I'm getting at here is I'm using industry averages. In the U.S. residential mortgage industry, when it relates to mortgage brokers delivering loans to wholesale lenders, what would you guess is the average lender paid compensation percentage that most mortgage brokers request? Now, I've given you a minute to think about that. Here's the answer. It's actually D, $10,000 or 2% of the loan amount. Now, is that fair or not? Well, obviously that's a subjective question. Some borrowers may think that's not fair. A lot of mortgage brokers might think that's very fair. And again, what that involves is we're getting compensated. This is the kinds of percentages that we would declare to our lenders we're set up with as to how much we want to get paid for each loan we deliver. So what that question and the answer reveals is that in the U.S., mortgage brokers on average ask their lenders to pay them 2% of the loan amount when that loan is delivered to them and funded by them. So then I would suggest to you that these different amounts, these ranges, again, from 1% to 2.75%, in this example, in terms of the four choices we gave you, 1% to 2.5%, that can have an impact. Not can, it will have an impact on what the actual rate you're going to get if you're looking for the best rate available from that broker based on not charging you any points. So let me give you, as a next example, what is the corresponding rate that you would get based on these four lender paid comp choices. And this, I think you're going to find this to be very telling. For the $7,500 lender paid comp, again, 1.5% of the loan amount, the 0-point rate, and I did this yesterday, by the way, and I think today's conditions are probably pretty close to this. If your broker is getting a lender paid comp of 1.5% of your loan amount, and you're applying for a $500,000 loan with them, that lender is going to pay your broker $7,500. and you're going to get a rate of 6.5 at no points. Now, what about B? What if your broker has lender paid comp set up with their lender, and you want a 0-point rate from that broker, but they have lender paid comp set up with their lender at 2.5%. That's $12,500 is what they want to be compensated for when they package your loan. Get your application, collect all your documents, make sure they're all in order, make sure that the package meets the criteria for qualifying and getting the loan approved, all the underwriting guidelines. They want 2.5% of your loan amount as compensation for doing that work for you. Well, guess what happens to your rate? You can see it there, 6 7/8, not 6.5. If you want a 0-point rate and your broker has demanded 2.5% of your loan amount from the lender they're going to deliver your loan to, and if you want a 0-point rate from that broker, they're going to have to offer you a higher rate, 6 7/8. That's 3/8 higher than if that broker was only demanding 1.5% lender paid comp. Well, let's look at C. If your broker is only asking for 1% of the loan amount on a $500,000 loan, that's $5,000. And if you want a 0-point rate from that broker, your rate's better. It's 6 3/8. In fact, you're 0.5% better if you're using a broker who only requires 1% lender paid compensation versus if you're using a broker who wants 2.5% compensation. So obviously you can see that's a big rate differential between a 1% lender paid comp and a 2.5% lender paid comp. And then finally, for number D, or letter D, a $10,000 lender paid comp. Again, this is the average in the industry. The average broker in the industry requests a 2% lender paid comp from their lenders. Well, that means the average broker out there, if you want a 0-point rate from them, a rate that's going to cover their compensation and then allow you not to have to pay any points in addition, the average would be 6 3/4. And guess what? That's still 3/8 higher than the broker who only wants 1% instead of 2%. So the underlying point to be made here is, I think when you're out shopping for a loan, what you want to do is a couple things. One is you want to do the shopping on the same day when you're talking to multiple originators. Again, whether it's a broker or a bank or a credit union, always get your quotes, preferably in writing, on the same day. And you're doing that to ensure that the quotes you're getting all are reflective of the market conditions on that day that all of us mortgage originators are dealing with. And then as you do that, and if you're seeing differences in the rate offered, and let's assume your one is 0-point rate, because that is a majority of the time what borrowers want. If you start to see some differences in rate from one originator to the next, especially if you're checking with multiple brokers, I think that's where you'll have the opportunity, and you should in fact inquire, okay, I've got your quote. Please tell me, how much are you getting paid for you to offer us these terms? And that would be an interesting conversation. One I certainly welcome, and on rare occasion I'll have a borrower ask me that, and I make it very clear and I'm very upfront about it as to where we are on this scale. But it's important that you do that because that will help you understand why you may see a differential in rates quoted from broker to broker or mortgage originator to mortgage originator, because what you're getting quoted in rate, especially if you want no points, is very dependent, in fact, directly correlated to what that originator, or in this case, we're talking about brokers, what that broker is going to get paid by their lender as per the lender paid compensation agreement they set up when they signed up with that lender, I should say. Now, in case you don't already know, if you've watched the show for a long time, and we've promoted this for a long time, but I thought this was a good point in time to go over this with you again. We pride ourselves and consider ourselves to be highly competitive with the loan terms that we offer to our clients. We've always had that focus. I generally think that in a lot of cases, borrowers are charged too much in terms of rate and fees. I'll remind you, for example, on the fee side, MortgageWorks in our 27-year history has never charged any miscellaneous fees, processing documents, underwriting, none of that. We never have. But more importantly, in terms of these different percentages of loan amount for lender paid comp, again, in case you aren't already aware, on most of our programs, we're at 1%. We're not at 1.5. We're not at 2. We're not certainly not at 2.5. Never have been. In fact, throughout the history of our company, we've generally ranged between. We were at one point as high as 1.5. We realized that was a little rich. We took it down to 1 3/8 and then 1.25. And for some time now, we are at 1 on most of our programs. So going back to these examples I just gave you, we would be number C or letter C in this example. If you need a $500,000 loan right now today, we'd be able to quote you 6 3/8. In fact, actually today, per our rate grid that we just showed you earlier, with the further improvement in the 10-year bond yield for a very good credit score and a good down payment size, we can actually get you to 6.25. And the reason for that is because we think, and we are running our business quite fine, very well, using a lower lender paid percentage declaration with our lenders, 1% of the loan amount. Because the reality is, we know what we're doing. The exhibits in a loan file are pretty standardized. Everyone in the industry knows what they are, what needs to be in that package. I mean, frankly, we are assembling a whole lot of paper. I mean, a loan file, when it's all done, can easily be 100, 200 pages, stacked. But we know what needs to go in there, and you can get into a kind of a subjective, value judgment as to where on this percentage scale for lender paid comp, what is fair, both to the originator and to the borrower. Well, again, we think that if we can earn $5,000 from a lender we deliver a $500,000 loan to, we think that's fine. That pays us adequately for both our expenses, our cost of doing business, and our profit objectives. But at the same time, it does what we really want to have happen, which is we want to give our customers the best possible rate that they can in the marketplace, while we are earning enough from the lenders we deliver the loan to that we can continue to run our business profitably. And I'm here to tell you, we can and we do that with our pricing scheme in terms of lender paid comp, and that gets passed on to you in a lower rate. So I just thought it was important that I kind of remind you of this is how it works, and kind of in the background in terms of how mortgage brokers are paid, why you sometimes will see a wide range of rates when quoted by multiple brokers, and there is a reason behind that. And so you've got to talk to yourself about, do you want to deal with somebody who thinks they need to get paid $12,500 for your $500,000 loan? Is that okay for you? Well, as a borrower, it may be. You may think that's just fine, and of course, more power to you. That's fine. They do a good job. And you're willing to accept a rate that would be required for them to get paid that handsomely, no objection here. I mean, you've got your free will and you can go where you want. I'm just suggesting to you that at MortgageWorks, we will generally probably offer you a better deal. And that's why, if you're entering the market to buy a home, realtor may give you a referral to a favorite lender of theirs. That's great. We have realtors who refer people to us all the time, so we're fully supportive of that process. But it may make sense for you from time to time to shop around. And if you do, again, make sure you do it in the same day, so you're getting numbers from multiple originators same day. But give us a shot. It doesn't take much for us to put a worksheet together. I just ask you a few questions, and with that, I can email you a worksheet, and then it's up to you. You can use it for comparison purposes, round file it, but at least you've got the numbers, and you can make an informed decision and fully understand why the rate you're getting is what it is, and understand more directly that a lot of that has to do with how much your loan originator is getting paid by that lender. And that way you know that up front, so you can make a better informed judgment if you think that's fair and reasonable for your transaction. So I hope that helps you understand a little bit more about the mortgage origination process as it relates to what kind of rate you can get, and in particular how it relates to how your mortgage originator that you're doing business with is getting paid, and how that directly correlates to the rate being offered. So with that, that's going to conclude our program for today. I want to thank everyone for watching and listening to this week's Mortgage Minute. I hope this background information on on rates and lender paid comp and mortgage brokers will be helpful to you as you shop around for that next mortgage, whether it's a refi or a purchase, by the way. And if you do, or if you're going to enter the market to do that soon, give us a try. We'll give you a no obligation quote and worksheet. Use that for comparison shopping, and hopefully at the end of the day, you'll get the best terms possible on your mortgage transaction. So with that, I want to wish you all a very good weekend, and then we'll see you again this week on next week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.